All right. Hello, everyone. Thank you for joining our webinar series presented by the graduate programs at RIT Saunders College of Business. My name is Jerrie Hsieh. I'm a professor and program director at RIT's MS in Hospitality Business Management. Today's webinar is Hotel Real Estate and Investment, Your Path to Financial Prosperity. I am pleased to introduce today's speakers, the two esteemed faculty members from our MS in Hospitality and Business Management program. First, let me introduce Dr. Steve Choi. Dr. Steve Choi received his Ph.D. from Cornell University in Hotel Real Estate. Welcome, Dr. Choi. Our second speaker is Dr. Debanjana Dey. Dr. Dey received her Ph.D. in Business Administration with a focus in finance and real estate from University of Central Florida. Welcome, Dr. Dey. All right. We are delighted to have Dr. Dey and Dr. Choi as new addition to our MS in Hospitality Business program this fall. They are currently teaching courses on hotel real estate and hospitality analytics in our graduate program. Our webinar will begin with presentation from Dr. Choi and Dr. Dey, followed by a Q&A session. So please feel free to type your question in the chat room, and I will facilitate the discussion. Now, let's welcome Dr. Choi to share insights on hotel real estate investment and real estate valuation principles. Dr. Choi, please.
Yeah, no, thank you very much, Dr. Hsieh, for inviting me and Dr. Dey today for presenting on a couple of important topics on this webinar series. It's really a pleasure to be here. So I'm just going to share my screen for the presentation, so today the topic that I'm going to discuss is essential valuation principles in real estate, and also touching on the topics that's related to some of the valuation techniques. So the presentation follows the format where I'm going to introduce and provide a couple of motivations, and I'm going to introduce a specific avenue where you can actually increase a lot of value in real estate, and sort of the application into hospitality, and conclude. So one motivation that I want to provide you is sort of understanding beyond what we, generally would think about discounted cash flow models, right? So if you think about a property or plot of land, you would think about, well, the stream of cash flow that's going to produce for the next 3 years, 5 years, and 10 years. That's the projected cash flows, and that's how you compute the return on investment, and also return on invested capital. But there are other ways through this presentation that I want to kind of highlight, where what we call in real estate terminology profit centers. Profit centers are basically, you could think about small niches where you can actually produce a lot of kind of little leeways for the cash flows that could be added on the model. So here I have an example of what we call air rights. So you can think about air rights as a particular tradable commodity in the real estate space. In fact, it's very prevalent in Manhattan, where there are a lot of sort of tall buildings. So this is, if you look at the left image, you look at a particular building that's uneven, right? So the light kind of brown is taller than the gray one. So for that particular difference in those on the heights, what the owner or the investor of the light brown building can go to the gray one and actually say, hey, you actually have this unused air rights on your space. Can you actually trade it to me so I can actually build even a more vertical structure on my particular parcel? And that's how actually air rights are traded. In fact, this is happening in New York City as we speak. So, investors often think about these kind of real estate as within the confines of the plot of land, but it's not necessarily true. In fact, you could actually have a lot of vertical extensions that could bring the cash flows and extend and enhance your valuation throughout the life cycle of the property. So this counterexample kind of shows you that if you own the plot of land, which is in Latin here, quis est solum ius est ad coleum, and ad infernos means whoever owns the soil holds the title up to the heavens and down to the hell, meaning that you also own the air that is above it. So a developer can buy adjacent buildings, unused airspace, and extend it. And as we know in real estate, sort of more vertical structures command higher premium. So this is another way to, what we say, squeeze further profit, enhance your valuations through this an example. Now, another example is what we call the contractual enhancement. So when you think about real estate, these are lease contracts, right? So lease contracts actually have a lot of contingency with them. So one way to think about, in particular in a retail space, is thinking about contingencies that tells you what happens if somebody that's next to you leaves the space. So you can think about Cheesecake Factory, right? Cheesecake Factory is a big, large, nationwide chain store in the retail real estate space. So when the Cheesecake Factory kind of comes into the shopping center, you can think about Rochester Eastview Mall, or you could any other kind of popular shopping centers, right? The shopping centers, when the anchor store resides within this in the retail store, that draws a lot of foot traffic. So you would think about there's positive externality in economics terms, right? But when Cheesecake Factory says, during like COVID, when there was a social distancing increase and the foot traffic therefore reduced, Cheesecake Factory could no longer actually pay the rent, and it might cease operations or shorten its operation hours. So the foot traffic further reduces. And in fact, if you look at Cheesecake Factory, the damages that could be done is the ecosystem within the retail system that are next to Cheesecake Factory, right? The little guys, Pandora, Sephora, Subway, L'Occitane. So these stores are impacted by Cheesecake Factory's potential departure. So what happens is that in the retail space, you can actually put a contractual contingency called co-tenancy clause. So co-tenancy clauses, you can think about as an insurance against an anchor store's departure. So if Cheesecake Factory leaves, I want to be insured so that I can have some limited time to rent relief on my base rent and possible exit option if no replacement anchor, no comparable Cheesecake Factory is found. So this is another way to actually taking a look at it, why contractual contingencies can enhance valuation. In fact, if you actually take a look at it, think about this insurance contract, right? So you're an investor. You're considering a shopping center in Rochester. You're considering a shopping center in Syracuse. So suppose Destiny USA, which is a shopping center in Syracuse, has a lot more of these contingencies. And suppose the Eastview Mall in Rochester actually has a significantly less contingencies. Which shopping center would you think has more risk, right? Which one would provide you more risk-adjusted return? Well, ex ante, you would think, well, if anchor departs and I have to kind of insure all these little guys, then your risk-adjusted return will actually be reduced, right? Because you hold all these insurance contracts that you would have to kind of pay them back if there's a loss of foot traffic because Cheesecake Factory leaves. But there's actually also upside potential to it, right? So if Cheesecake Factory is a really robust, credit-worthy tenant, then the ability to collect these insurance premiums would actually juice up your ROI, IRR, and NOI. So there are higher rents that could be baked into your contract because of these contingencies. So your shopping center value actually will increase. So in fact, this is one of the co-authored studies that I am having as a working paper. If you think about on the left-hand side, a shopping center without co-tenancy, right, without this contingency, and with co-tenancy, the way I juxtapose it is I'm looking at how much is it sold above asked price. So it's a ratio between sold price over list price. In fact, with co-tenancy, it's actually sold higher, right? So this is obviously, there are a lot of factors you have to control for, but it kind of brings you the idea that these contingencies are not always negative. It can be baked into contractual agreements where you can be actually paying a lot of value. In fact, on the right-hand side, I count the number of tenants with these contingencies, with these insurance contracts, and actually you can see the sold price over list price ratio is actually slightly increasing as you increase the number of co-tenancy contracts. So these are some of the motivations where I just wanted to kind of give you a different perspective, where it's not the parcel of land that you should really confine as an investor to look at a value, of real estate, right? There are a lot of different profit centers here and there, such as air rights, right? Vertical extensions, redeployment, conversions of the space, or you could think about contractual contingencies that could be implemented to really juice up your return. So given the interest of time, I'm just going to look at particular contractual model because this is my expertise. So one way to think about a lease contract in retail space, and this actually holds in actually hospitality too, because if you think about hotel rooms, these are daily leases, right? So you can think about, one model you can think about is the U.S. Treasuries. So what happens is that in the U.S. Treasuries, the bondholder lends principal, and the U.S. Treasury pays coupon on that principal and returns the principal, right? That's the whole model of a U.S. debt, government debt. So in a similar way, you can think about shopping mall landlord lends the commercial space, such as hotel owner lends the hotel room space to the tenant, right? To the guest. And the tenant or the guest pays the rent. And at the end of the lease term, or suppose if it was a hospitality guest, when the guest checks out of the room, they return the space. So here the contract is a shopping center lease, but it could be hotel room lease, which is daily leases, right? And the principal here is retail space or hotel room space, and the coupon is the rent, right? It's the daily rate, rate that you pay on the room, and the term is the lease term. And in terms of hospitality, these lease term it could be 3 nights and 4 days, or 2 weeks and then 2 weeks and another day. So here the debtor is the tenant, the hotel staying guest, and the creditor is the landlord, right? The hotel owner. Now you can think about this contingency as an insurance on a coupon-bearing bond, which I just described. So you can think about, depending on the anchor tenant, the Cheesecake Factory's action, then this insurance either activates or it just kind of stays as mute. So the way you can think about these, contingency contracts is as an insurance on the coupon-bearing bond. So what does it look like actually in a contract, right? You're all talking about these real estate contracts. We have to notarize them. We have to go through the escrows. What does it look like? So contingency clause on this particular case looks like this. So you can think about X as a Cheesecake Factory and Y as, let's say, Subway, right? Or Pandora. So if Cheesecake or any similar substitute is not open for business, so that's when anchor is about to leave, then Pandora can terminate the current rental lease or pay 50% of base rent for 12 months. So that's kind of a grace period, right? The landlord has to get out another tenant, or kind of that's the period where it can get cured. So if an acceptable tenant has not opened, right, if nothing has been resolved, then Pandora can either terminate the current lease or return to paying the full base rent. So that's kind of the fish or cut bait, right? You either terminate the lease or remain in the center. So that's sort of the contractual example of how you can put this contingency in real estate contract, where if you believe this X, which is the anchor tenant, is a really sturdy, robust, credit-worthy a tenant, that you can really just keep collecting these insurance premiums, right? And bake into your cash flows, which will produce trajectories with a higher valuations. So this is a simulation model that in the working paper with my co-authors that I did. So you can think about on the y-axis as an excess return per unit of risk. So you can think about this as similar as something like a Sharpe ratio, right? Something that provides you what is the excess return that you're taking per unit of risk. So the way that you would think about it is, well, what is this premium of putting in this contingency insurance contract into your rental agreement? Here in the simulation model, which is a very general model, it's about $3.17 per annual per square foot. Now, I don't, you might think of this as small amount, but in general, in shopping centers, the annual per square foot rental, base rent, ranges from $2 to $35. So this is not a small amount, right? Imagine you have a couple of tenants actually with $3 plus based on your, baked into plus to, in addition to your base rent, that's going to bring you a lot of juiced up cash flows, right? So that's why these contingencies are quite attractive. Now, I do want to kind of just, glaze over some of these applications. So, in air rights and hotels, taller hotels command higher premiums, right? Because any hotels that are not courtyard or 2-3 stories high, it definitely, compared to Conrad or Four Seasons, you're gonna command much higher premiums because of the view and so forth, right? So you can transfer unused airspaces for vertical extensions, but now because of a lot of sort of activities involved in cutting carbon emissions and building vertical structures that are involving a lot of sort of civil engineering, that you might actually have to think about, well, how do we incorporate this climate risk or zoning factors into it? And that's a little bit more complex valuation that can be done, right? And you can think about hotel leases, right? Hotel rooms are basically daily leases that I've actually, as I illustrated them. So hotel rooms are based on daily leases with fluctuating daily rents. So even if you book 3 nights and 4 days in New York City, each day your daily rate's going to be different, right? They're fluctuating. So you can look at potential contingency, insertions in these contracts that could actually extract some value and add it to the current pricing model. So in conclusion, why do we care about these sort of, if you will, non-linear way of thinking, right? Not just parcel of land, because there are various profit centers that you could take a look at that you can really squeeze as an investor and developer in these cases. And I think these niches matter because it might encumber cash flow at first, if you think about just like, the risk-adjusted return was lower, but if you look at closely, it could really be proven to be a source of profit through the long term. So the main takeaways, I think, there's a strong need to build a lot of tractable models that could value these real estate niches, if you will, air rights, contingency claims, insurances. And I think there's a lot of room to kind of employ that in the real business sense. So thank you. Yeah.
All right. Thank you, Dr. Choi, for your valuable insight into hotel real estate investment and real estate variation. Next, we have Dr. Debanjana Dey, who will discuss hospitality real estate development and careers.
Thank you, Jerry, for that introduction, and thank you for having me here today along with Steve. So I'm just gonna start sharing my screen. All right, so I'm Dr. Debanjana Dey. I'm here, like Jerry mentioned, that I just joined this fall, and today I'm going to talk a little bit about the hospitality real estate development, what it exactly is, and also real estate investment trusts or REITs, through which normal people like us can also invest in real estate properties. So the outline of this presentation is going to be about real estate development, careers in development, what is the economic impact from development, and then we're going to talk a little bit more in details about hotel REITs. So, the first question that everybody was, why should we care about development at all? Well, the answer is pretty simple as well as complex. The answer is right in front of you. Buy land because God ain't making any more of it. So the demand for real estate properties is constantly increasing as opposed to land, which is not as much in availability as you would think it is, at least habitable land. So that's why I think it's a good idea to be a part of the real estate development process and understand it so you can actually build a career out of it. So the real estate development process includes all of these different steps, starting from site selection. How do you actually select a piece of land? Where do you select it? What is the market? Does this market have an appetite for apartments or hotels or office spaces? Does the market actually need that? So we need to think about all of these things before we actually do a site selection. Then we have to go through the entire legal process of land acquisition. We have to justify whether the property that we're trying to build, whether it be offices, whether it be apartments, whether it be a hotel, are the numbers working for the people who's going to lend us money? Because none of us have the entire millions of dollars to build the entire project. So we need to borrow money from people. So we need to work the numbers, or which is called a feasibility study, to show what is whether the project is economically feasible or not. And then we move on to the more design and planning phases, acquiring the capital to start our construction, finding out what permits and approvals. So are we in a zone that allows hotels? Are we not in a zone that allows hotels? So we need to find out all the permits and approvals that we need. And that is a tenuous process that requires lawyers, that requires you to have a knowledge of the local market, that requires you to have connection with the local regulatory authorities as well. And then we move on to the construction phase. And believe it or not, before the construction phase is even over, we move on to the marketing and sales phase, so that by the time the construction is over, you have sold out your apartments, or you're sold out the leases for your office space. And we're not done yet. Even after the construction phase is over, you still have to maintain operations so that your building appreciates in value, and you continue to make money, because that's the end of it. Real estate is a high reward and high risk investment opportunity. So we always have to make sure that are like a stock. So the company has to continue to perform well, and similarly for real estate as well. So who can be a real estate developer? Well, that's the beauty of real estate. Anyone. You can have varied interests, starting from architecture to hotel management to construction to business, finance, accounting, real estate, and law, and still be a part of the real estate development process and still have a career in real estate. So whether you have analytical skills, you have problem-solving skills, you have decision-making skills, you have a career in real estate. And generally, if you want to become, let's say, a lead developer, what developers generally have is creativity and decision-making skills. Or let's say you don't want to become a lead developer, you want to be a part of the process. You could be a real estate market analyst. You are basically a problem solver. You're a risk taker. If you have more communication skills, negotiation skills, you could be a sales and marketing team manager as well. So that brings me to the different set of skills and what, the different roles in the real estate development process. Like I said, analytical skills could, lead to a real estate research analyst role or a market analyst role. If you have more project management skills, your skills are very important to a construction company. If you have communication skills, you could be a part of the sales and marketing team, a development coordinator, or public relations. And I believe people with communication skills are the most perfect, the most perfect example of who should join the real estate development process, because this process involves so many people, and you need to coordinate and keep together so many people. Coordination skills and communication skills are the most important skills, in my opinion. And then you can move on to more financial skills. Leadership skills would get you to the more executive positions. And if you are more of a creative kind of person, interior designers, and trust me, interior designers are very, very sought after right now in the real estate development field, especially in a hospitality industry. So these are some of the salaries, roles and salaries. These are either taken from surveys or Glassdoor and Indeed. So these are junior level positions for either a bachelor's level degree or a master's level degree. And of course, as you move up in your ranks, your compensation could well be above the 6-figure mark. And if you look at this chart over here, the average total compensation for the executive positions are constantly increasing from 2016, which is about 200K, to 2022, which increased to 250. So we're on the rise. So it's not going down anytime soon. There are several hotel property developers and other property developers that you can work for. And in this context, I do want to mention that our former president and very controversial president, Mr. Trump, actually became famous as a real estate developer. So he had the Trump organization, as a part of the Trump organization, he renovated the Commodore Hotel in Hyatt Grand Central, New York City. So there are some of these companies you may have heard of. Related companies is behind the Equinox Hotels, and the Tishman Group is a very well-known corporation. And then there are other companies as well that do not just focus on developing hospitality properties, but they're developing apartments, offices, retail, industrial. And so all of these skill sets that I just mentioned will be, of very much interest to any development company. And this is, so far we've talked about, what you personally, stand to gain out of a real estate development career. But there's a bigger picture as well. Real estate development is not just about your career. It also has a significant impact on the economy. For example, if you're talking about hotel development, it generates revenue that pays your consumers, it generates revenue from the consumers that pays the bills for your employees and workers, right? And when you actually build a hotel, you have to pay taxes, and these taxes go to federal, state, and local governments, who use these revenues to help the community, help the locality. And sometimes they will even offer you incentives in order to stimulate the development of hospitality properties there, simply because more tourists coming in means more business. It has indirect impact on contractors and suppliers, like the people who's providing you with food and beverage or utility. And there's the induced effect, which is basically when you build a new type of income generating property, there will be people, like in terms of hotel, there will be, managers, housekeepers coming in and settling in the area, paying rent in the area, buying from shops in the area, and that helps the local community as well. So now we're going to talk about the real estate investment. So far, we've talked about development, and you could be an owner and a developer, or you could be an owner who hires a developer, or you could just be a developer yourself. But what about ownership? How do you actually own real estate? It's, we have a lot of preconceived notion about real estate is hard to invest in. It requires a lot of money. Well, let's talk about, how you can bypass those preconceived notions. So you could technically invest in real estate directly by buying a vacation or a rental home. If you rent out your home for less than 15 days, then there's no income tax. But if you rent it out for more than 15 days, you do have to pay income taxes. However, there are several deductions that you can do from when you're doing your taxes. Or you could invest in, let's say, a residential property and turn it into a rental property, like an Airbnb. You could be investing in a commercial property. You could be investing in raw land and hiring or developing the land yourself so that it appreciates in value, and then you can sell it as and make a profit out of the difference. But the more general or practical way to invest in real estate as an individual investor or a retail investor like us would be to use the real estate investment trust, which works similar to a mutual fund. So it means that it pools the money of many investors, and it has a professional manager who manages your money and invests your money in real estate. So they invest in malls, hotels, office buildings, and retails. And so whenever these income producing properties make money, you get a share of that profit. So that's how it works. Or some real estate also invest in mortgage-backed securities, or so basically when you buy a home, you're taking a mortgage, right? And so several thousand people are taking these mortgages. And so Wall Street has come up with this beautiful innovation where they pool all of these mortgages and create a security out of it. And so When you pay your mortgage and your fees, a part of those mortgage and fees, the interest that you pay goes back to the investors through the REITs. And so those are the mortgage REITs. There are several advantages of investing in REITs. Let me start by talking a little bit about the characteristics of REITs. REITs do not have to pay taxes. They must distribute 90% of their earnings to shareholders and usually have high yields. Dividends from REITs are not tax deductible. However, they do qualify for certain deductions from your taxable income up to 20%. These are ideal for your tax-deferred accounts and are typically listed as a stock on a major stock exchange. So if you're wondering what are the different types of REITs, so this is like a breakup of the different the type of properties that the REITs invest in. And as you can see, lodging, mixed use, and specialty REITs, they are a significant portion of the market. So you can technically invest in lodging, hospitality properties, retail properties, and mixed use properties through these REITs. Then there are other ways to invest in real estate, or at least get the profit of real estate as well, if you invest in the real estate ETFs. So ETFs generally follow what is known as the market index. So just in the same way, S&P 500 kind of gives you the health of the entire market of the United States, there are indexes that gives you the health of the real estate market. So for example, iShares Dow Jones US Real Estate Index is an ETF that follows the real estate index. And so if the real estate market is doing well, you make money out of it. And trust me, these ETFs are continuously growing in number. And so there are so many of them. You can also research a little bit to find out if there are more of these. And then there are a couple of other not so well-known REITs. Those would be the private REITs that are not traded on public exchanges and usually require accredited individuals who have like a lot of net worth, at least a minimum of 1 million net worth, and their minimum investments also are typically very high for most individual investors. There are some non-traded REITs as well that are not listed in stock exchanges, but are registered with the SEC or the Securities and Exchange Commission. They also have higher minimum investments amount. So that's the end of my presentation. Thank you so much.
Thank you, Dr. Dey, for your enlightening presentation on hospitality real estate development and careers. So now we will open the floor for audience questions. So, if you have any questions for our speakers, please feel free to type your question in the chat room. And while we wait for those, I actually have a few questions for our speakers. Okay, so Dr. Dey, you mentioned hotel real estate investment and its capital requirements, and we know that unlike purchasing a single house, to invest in the, like a hotel, commercial building or hotel real estate, it actually involves, a significant capital. So, are there opportunities for small scale investors like me to become hotel owners, given the significant capital involved?
Right. So that's a very good question, and let me move over to a slide that will help me answer this question. So this is a sample data from one U.S. market. So who owns these hotels? And as you can see, Real Estate Investment Trust owns about 27% of all the hotels. So yes, so this discussion on our REITs, I think, was very helpful in explaining how we can be a part of these hotels as well. You simply invest in the Real Estate Investment Trust to become a part owner of the hotels. And so let me talk about this as well. But why would investors actually want to own hospitality real estate in the first place? Well, like I said, hospitality is a high risk, high reward game. So even though it is high risk, there are investors who want high reward. So for them, it's important to invest in hospitality real estate, which would provide them with a high return. Tax benefits I already talked about, and one of the biggest one, in my opinion, would be the ESG. So several investors right now care about green buildings, and as we move on to hospitality buildings kind of accepting and adapting to the LEED certifications and standards, it has become a more lucrative opportunity for investors to invest in hospitality real estate. And then there's the question of diversification. So let's say I own Apple, I own gold, I own a bond. I want to diversify my returns. And diversification means that you buy an asset that has a return that moves in a different direction than another asset, which means that if you put them together, your overall risk reduces. So hospitality REITs investment would serve as one of those ways how you can actually reduce your risk as well.
Thank you, Dr.
They're
Dey.
kind of different.
Yes, please.
Sorry,
Yes, please.
sorry, I think I just had like one slide here. They are kind of different from other real estate investments because hotels, as you know, have operational complexity. They have different revenue sources. The market sensitivity, like what happened during COVID, was the entire tourism and hospitality industry got choked up. So obviously, this market was more sensitive to the rest of the market as well. And then, like Dr. Choi mentioned, lease structures are one of the prime ways how these real estate investments can be different from other types of investments as well. So I'll stop there in the interest of time.
Thank you, Dr. Dey. Dr. Choi, do you have anything you would like to add into the, Dr. Dey's comments regarding the, small scale investors to become hotel owners?
Nothing too much, because I think Dr. Dey covered quite well on that. So thank you.
Okay, all right, that's good. And then we got questions, from our audience. I think the first question is that I was curious about the income tax exclusion for rentals under 15 days. Is that for any owned real estate, or is it just for your primary residence?
So it's not actually for primary residence at all. So this is only for vacation rental. So if you own a vacation rental and you rent it out for less than 15 days, then only you are subject to no income tax. But usually you won't invest in a vacation rental just to rent it out for 15 days a year. So what you would do is to buy a vacation rental and rent it out for more than 15 days, but you should check out what tax deductions you can obtain from that rental income, because there are some available.
Thank you, Dr. Dey. And the second question is that it's about the private REITs, REITs. Okay, and according to the audience, I have folks in my network of investors that are targeting qualified investors. What are the startup costs for that? And is there a way to obtain private financing without REITs? Meaning, what kinds of restrictions are there from soliciting private financing for a real estate opportunity? I know there are private hard money lenders, but is there any way to crowdfund without running afoul of investing rules?
Okay, so I can answer the first part of the question, definitely. For the startup cost, let me go back to the slide. The startup costs for private investment, as you can see, that you have to be an accredited investor, which means that you have to have a minimum net worth of 1 million or an income of 200,000 per year, or 300,000 if married. So that's a hefty amount. And, even the minimum investments for private REITs can range from anywhere between $1,000 to $50,000. So those are not recommended for individual investors like us, and that's totally personally my opinion. And then in terms of obtaining private financing without the REITs, of course you can. Like the first source of obtaining financing is your friends and your family, right? So there's no repercussions to obtaining financing from people that you know. However, when it comes to crowdsourcing, I'm not quite sure of the laws. Honestly speaking, I am not.
Good, thank you. And so fantastic. Moving on, I'm very interested by the potential role of AI in hotel real estate investment decisions. So, Dr. Choi, maybe can you share with us if and how AI have been effective in this context? In the real world that the investors really use the AI to help them to make the investment decision.
Yeah, so I think one of the hot topics is what we call geospatial analysis using deep learning methods. So there are a rising number of papers and research that's actually done. I also, talked to Wagman's real estate division to see what they have done with the information, because there's so much information that's related to where consumers are going, what kind of transactions they're making. So you could map consumption data based on where the footprint data are. So these geospatial data can provide you some insight to, for example, if Four Seasons is opening a hotel or Marriott is opening a hotel, then you can do a site analysis to see where might be another potential site that could be a great opening to draw a lot of customers. That's within the attraction sites and also very convenient location. So I think there are a lot of sort of neural network AI applications to geospatial analysis of the hotel openings and sort of looking at where the foot traffic of the hospitality and the guests are. Yeah.
Thank you, Dr. Choi. Dr. Dey, do you have anything about the AI related to the investment decision like you would like to add?
So I think Dr. Choi was pretty much covered it, but I would just like to add, it's the same case with the leases as well. So an AI can go through hundreds and thousands of lease documents to actually find out if there is there's a market with potential for outside future rent growth. And that could be a potential investment area as well. And then the other thing that I wanted to talk about is the fact that we're talking about investments, but from the development side, if there's a lot of demand for AI, that means we're going to need a lot of compute data centers as well, because AI uses so much data, right? And so I think JLL has a lot of research on this, but to quote on what they have, is the fact that the number of centers that China right now is developing for data centers is like doubled over the years. And so this will continuously create the need for data centers like that throughout the world, and even in China. So, that's my take on the impact of AI in real estate.
Fantastic. We do have a question from the audience regarding the rising interest rates. So the question is that, how does rising interest rates affect real estate when renting it out and the income variation of the property, etc.? So who would like to address this question first? Anyone?
I can go first. Okay, so I read actually just before the Thanksgiving that the mortgage interest rates showed some signs of relief for actually home buyers. So they dropped from, I think it was 7.5 in the early November to 7.4. So this is kind of 3-week drop as a Fed also halted the interest rate hike. So on one hand, it's giving more incentive for renters to actually expect, have a form an expectation that in the spring the interest rate actually will go down, so they might be more feasible to actually purchase homes or do so. From the person who is actually renting the property, that would mean there's some loss of demand, right? Because there will be a particular group of market participants who are now demanding home purchases as opposed to the renters. So I think as of a current trend and forming expectation going into Q1 and Q2 of 2024, there will be a slight, because there's a relief in the interest rate hike, that there will be potential loss in the demand for the renters. But in general, just the economics speaks that if the interest rate hikes are actually continued, then many people will be unable to afford home, because interest is actually inversely related to the home affordability for the purchasers. So there will be a lot more people who alternatively rather rent because they cannot afford mortgage payments. Yeah.
All right, thank you, Dr. Choi. Dr. Dey, would you like to add anything, or you want to skip the question?
I think Dr. Choi pretty much covered it. In general, interest rates always affect real estate investment. So even if you're investing in REITs, you should always keep in mind that the interest rate, the risk is also a part of REITs investment as well.
And I have a question for the audience asking about other slide presented confidential. No, the slides are not confidential. If you are interested, in our PowerPoint slide, we will be happy to share with you. And actually, since this webinar is recorded, so actually after the, our webinar, after the presentation, we will send you the link so you have fully access, to the to our webinar today. And okay, I think that I'm going to wrap up. Before I wrap it up, I have one last question, for our two speakers. Okay, so, when we talk about the hotel, investment, the investor may thinking about different type of hotels. They are upscale hotel, middle range hotel, economy hotel. They are like business hotel, resort, conventional hotels. There are so many types of different kind of hotels. Are there any figures indicate that which type of hotel usually yields a better return on investment, and what other factors contribute to this trend?
Okay, I'll go first. So it really depends on several factors, because real estate is such a local market. So it will definitely depend on the market demand, what the economy looks like. But in general, I would say that in the past few years, the demand for upscale properties is higher than the supply of it. So my guess would be that the return on investments on these kinds of properties would be higher than the mid-scale and the low-scale hotels. There are other factors. For example, I would say usually luxury properties and full-service hotels offer a wide variety of amenities, right? They also have higher prices. So I would think that they would generate a higher revenue than limited service and extended or low-scale type of hotels. Yeah.
Thank you, Dr. Dey. Dr. Choi, would you like to add anything? Any comments regarding which type of hotel will yield, a higher return on investment?
Yeah, I echo Dr. Dey's comments. I think it's a function of many things, and I think one of the important factors is the state of the market. So, if you look at domestic travels in continental US, it recovered 100% to pre-pandemic levels. And also there is a sort of relief on the inflation and also gas prices and airfares. So that's gonna obviously push a lot of travelers to travel and seek even, mid-scale to luxury properties. So I think at this point, even though there is some lingering doubts on recession, for some folks that the Fed has halted the interest rate hike, and also that the travel has recovered quite well, and the RevPAR measures are looking more solid, right? So it's a more of soft landing. I think the mid to the luxury scale is probably more attractive as of now. But then again, I think it will be a function of the current state of the economy. Yeah.
All right. Thank you both for sharing your valuable insights regarding this. If you are eager to delve deeper into the hotel real estate investment, we would like to invite you to explore our MS in Hospitality Business Management program. This forward-thinking program available both online and on campus, with a focus on technology, analytics, customer service, sustainability, and hotel real estate. So this program not only paved the way to a career in hotel real estate and investment, but it also opens doors to opportunities in asset management, project management, revenue management, brand management, and customer experience management. So we are currently accepting the application for fall 2024. So if you are interested in joining our MS in Hospitality Business Management program, please contact me at this email address, yhsieh@rit.edu, yhsieh@rit.edu. And also that, RIT does have a real estate, club. This club meets, on Mondays from 5 p.m. to 6 p.m. So if you are interested in joining this, real estate club at RIT, please email Ben at, Ben's email address is bch9414@rit.edu. Again, if you are interested in joining the real estate club, the email address is bch9414@rit.edu. Okay, thank you very much. I want to, express my sincere appreciation to Dr. Dey and Dr. Choi for their insightful presentation. And thank you all for being part of today's webinar. Have a wonderful day. Thank you. Bye.
Thank you so much. Bye.
Thank you. Bye-bye.